Hi there, welcome back to Stillwater's ASMR. Today I am just going to be doing some studying. So if you're going to be studying along with me, then pull out your books, sharpen your pencils, and let's get into it. It is the 24th, first. Accounts. Preparation. Final accounts preparation instruction. The study manual will provide you with all the knowledge and skill to succeed in the final accounts preparation unit of the advanced diploma of the AAT course. It is suitable both for home study courses and also classroom-based students. There are questions at the end of each chapter to aid learning and give practice in the topics covered in that chapter. All the answers to the questions have been included at the back of the book. To benefit most from this book, you will need a basic understanding of the trial balance, the statement of profit or loss, and the statement of financial position. If you don't have this understanding, you should read Advanced Bookkeeping by Alan Dawson, available from Berkeley Books. Business structures. Business structures. In this chapter, we'll look at some of the most popular business structures. We will look at the different regulations covering each type of organisation. We will see who owns and manages the organisation and where the responsibility for any debts lie. We will look at whether and how any tax is paid. We'll look at what financial statements are due for each type of business. When a person tries to start a business, they will have to choose a structure which is most suitable for their needs. The structure will determine the paperwork needed to get started, the taxes they will need to pay, how profit can be taken from the business, and the personal responsibilities of the business makes a loss. The majority of businesses are set up initially to make a profit. There are not-for-profit organisations, mostly charities, which we'll look at later in this chapter. There are 4 main business types, which are set up to make a profit. So we've got a sole trader. If a person starts working for his stroke herself, they are classed as self-employed, a sole trader. Self-employed. A sole trader runs their own business as an individual. If a person starts working for herself, they're classed as sole trader runs their own business as an individual. Liable for any expenses means the sole trader has to find money for expenses even if no profit has been made. If there is no money in the business to pay these expenses, then the sole trader will have to find the money from private means. In extreme circumstances, the trader's personal possessions can be seized and sold in order to meet the expenses. On starting the business or keeping records. You can start the business as your own name or as a business name such as Premier Plumbers. The only requirement is that you fill in a tax return every year and pay income tax and national insurance on the profits. National insurance on profits. There is no more legal requirement to keep records other than a statement of income and expenses. There is no more legal requirement to keep records other than a statement of income. Right, so we need statement of income and expenses document. Statement of income and expenses and documents to prove it, e.g. receipts and invoices. The business may have to register for VAT if the turnover or sales exceeds its registration threshold. If you register for VAT, then VAT will be chargeable on all taxable sales, but VAT can be recovered on all taxable purchases. Advantages. The main advantage of being can become VAT registered. The main advantage of being a sole trader is that the trader makes all the decisions him or herself. No one has to be consulted beforehand, meaning the decisions can be instant. The trader is alone responsible for the success of the business. No one else can make poor decisions which will affect the profit made. The owner will bring his or her own skills to the business. There isn't a problem of relying on someone else. There is very little in the way of red tape. A record of income and expenses and a resulting profit or loss is all that is needed legally. However, there will be a few banks which will lend a business money without. Proper financial statements. We will look at financial statements for sole traders like in this book. A sole trader can claim expenses, which is set off against income. Tax deductible expenses are allowed such as business travel or even premises costs, even if the trader works from home. Disadvantages: the owner's liability is unlimited. This means that any expenses due must be found either from the business or from the trader's personal funds. It could be the trader loses their car or even their home if the debts are great enough to warrant this. The trader is limited to the skills he or she can bring to the business. If the sole trader doesn't have the skills for a particular job, then they will have to pay someone else to do them. For example, sole traders often need to employ an accountant to keep track of their income and expenses and to complete a tax return each year. If a sole business may have to stop altogether. Sole traders often have to work long hours with no one to relieve them. Taking any holidays at all could be a problem. Profits are taxed as income, just as they would be if the trader was employed. As the business begins to grow, the higher rate thresholds will soon be reached. Why become a sole trader? Being a sole trader is the business type to choose if there is little or no startup costs, and you're unlikely to need to borrow money to grow the business. However, being a sole trader can be a lonely position. The advantage of being your own boss must be balanced with the fact that there's no one to validate your actions. If you're confident that your business will succeed, and you will incur little or no loss, then this will be the best business type for you. While you will have to inform HMRC, Her Majesty's Revenue and Customs, that you are trading, there isn't very much else to do in order to get started. That's right. Partnerships. A partnership can be formed as a new business, or it may be a sole trader who wishes to see the business grow with additional skills and capital. A partnership is a type of business to form Pussycat, stop that. A partnership may be formed as a new business, or it may be a sole trader wishes to see the business grow with additional skills and capital. A partnership is a type of business to form if you wish to offer services with people you know. Typically, a partnership will be a group of friends, typically between 2 and 20, or maybe a husband and wife, or any associated people. The partners will share responsibility for the business. There is generally a partnership agreement drawn up, which among other things shows how the profits of the business will be shared between the partners. Anything taken from the business by the partners are known as drawings. Anything not covered in the partnership agreement will be covered by a piece of legislation called the Partnership Act 1890. We'll look in more detail at the Partnership Act later in this book, but for now it's enough to state that it says all profits will be shared equally between the partners unless there's agreement to the contrary. Is almost as flexible as a sole trader. There is no set form of recording the finances. A record of income and expenses and resulting profit or loss is all that is needed legally. Each partner will pay income tax and national insurance on their share of profits. Each partner will send a tax return to HMRC each year. Each partner will send a tax return to HMRC each year according to their share of the profits, and the nominated partner will send a tax return for the whole business. The business may have to register for VAT the turnover the sales exceeds the registration threshold. If it registers for VAT, then VAT will be charged on all taxable sales, but VAT can be recovered on all taxable purchases. Yes, sweetie, I hear you. There is shared responsibility. This allows for specialization where one partner can bring one type of skill to the business while another will bring another type of skill. With more people running the business, there is a possibility for more capital being introduced, which in turn gives more potential for growth. With more people running the business, it's easier for the partners to take holidays and cover for illnesses. Disadvantages: partnerships have shared ownership and shared responsibilities. Any decisions should be agreed by consultation with other partners, so decisions are not always instant. There will be disagreements between the partners on how the business is run or what contracts to accept or reject. The partnership may be disadvantaged if a partner leaves or retires because a key skill may go. Just as with sole traders, the liability of the partners is unlimited. Debts must be paid for even if this extends to the partner's personal possessions. Partners in a partnership are responsible jointly for the debts of the other partners. If one partner runs up a debt for the partnership, then all the partners are responsible for the repayment. It's important that you know the other partners well. Limited companies are incorporated businesses. Incorporating means registering a limited company. At Companies House, to register a limited company, the business will need a memorandum of association, a legal statement signed by all initial shareholders agreeing to form the company. Articles of association, written rules about running the company agreed by the shareholders and directors. A limited company is where a business is formed which is quite separate in legal terms from its owners. The owners are shareholders, but the company's finances are separate from the shareholders' personal finances. The shareholders have limited liability. Meaning that they are only responsible for the amount of money they have invested or guaranteed to the company. There are two main types of a limited company. A private limited company may have one or more shareholders. The shares cannot be offered to the public. Both kinds of limited company must be registered at Companies House, and each must appoint a bookkeeper and a director, at least two if it's PLC. Directors manage the business. Each year, a limited company must file its accounts with Companies House, where the figures are open to the public. Must file accounts annually. Profits distributed to the shareholders each year are called dividends. In proportion to the number of shares owned. Some of the profit may be retained by the company for use within the company to pay future debts or for future investment. Small businesses may register as limited companies. There may be one shareholder and one director who may be the same person. In other words, a sole trader can elect to become a limited company. The Companies Act 2006 is the law relating to limited companies. This is a mammoth piece of legislation with 1,300 sections. Sections 380 to 474 cover accounts and reports. It states that the directors of every company must prepare accounts for the company for each of its financial years. The Act states every company must keep adequate accounting records. Adequate accounting records means records that are sufficient to show and explain the company's transactions, to disclose the with reasonable accuracy at any time the financial position of the company at that time, and to enable the directors to ensure that any accounts required to be prepared comply with the requirements of this Act. Accounting records must in particular contain entries from day to day of all sums of money received and expended by the company and the matters in respect of which the receipt and expenditure takes place, and a record of all the assets and liabilities of the company. If the company's business involves dealing in goods, the accounting records must contain statements of stock held by the company at the end of each financial year of the company. All statements of stock taking from which any statement of stock, as is mentioned in paragraph A, has been or is to be prepared, and except in the case of goods sold by way of ordinary retail trade, statements of all goods sold and purchased, showing the goods and the buyers and the sellers in sufficient detail to enable all these to be identified. The Act also debates on what accounts must be kept. The financial statements which must be kept are statement of profit or loss, statement of financial position, notes smaller limited companies may be relieved from supplying a director's report and from an auditor's report. The Act requires that directors of a company must send their annual accounts to Companies House. This is an agency of the government and is where all companies must register when they were formed. There are strict deadlines for filing of company accounts if the shares of a company are offered for sale to the general public. The accounts must be filed 6 months after the end of the accounting period if the shares are not offered for sale. Must be filed within 6 months. If the shares are not offered for sale to the general public, private limited company, the accounts must be filed 9 months after the end of the accounting period. Right, so if we do April, May, June, July, August, September, so that's like September. April, May, June, July, August, September, October, November, December, so it's December. If the filing is late, the company will face a fine. A fine for late filing. Between 150 and so that, depending on how late the accounts are filed, repeat late filing will result in the fine being doubled. Those companies which are quoted on an official list as having shares for sale must also make their annual accounts available on a website. Every year the company must circulate the financial accounts, or in some cases a summary of the financial accounts, to each shareholder. An annual general meeting, AGM, must be held each year where the accounts are approved by the shareholders. By far the most important advantages of the owners of shareholders are limited in their liability to the value of their investment. If the business doesn't have enough money to pay its debts, then shareholders don't have to find the money from their own private funds. The tax is more favourable for limited companies. Limited companies pay corporation tax on their profits. Pay corporation tax on profits. We should bear in mind that directors will be paid as employees and tax on their income in the same way as an employee. Paid as employees and taxed on. Shareholders will be paid a dividend. According to the shareholders, there is no tax on dividends up to 5,000. Amounts above 5,000 take at 7.5, 32.5 and 38.1% according to the level of dividend income. Compared this, the self-employed person who is taxed at 20, 40 and 45% according to the level of income. lodged with Companies House to become public. Anyone can go on the Companies House website and see all the financial statements of all incorporated businesses. Unlimited liability partnerships. This is Britain's newest business type. It is seen as a hybrid between limited companies and partnerships. They offer a limited liability of limited companies, but the tax regime and flexibility offered to partnerships. LLPs are covered by the Limited Liability Partnership Act 2000. The partners are called members, and the membership will probably, but not necessarily, have a members agreement similar to the partnership agreement for ordinary partners. Partnerships. The business is owned by the members. Members pay income tax and national insurance to share their shares. An LLP is set up by registering the business with Companies House. There must be 2 or more designated members who are responsible for filing accounts with Companies House annually. As with limited company, an LLP limits the liability of the members to the amount they have invested in business. However, there aren't the same tax advantages as with a limited company. Each member will be taxed as an individual on their share of the profits. The financial statements required by Companies House are the same as for limited companies, with the exception of the director's report. LLPs must start trading within 1 year of registration or they will be struck off. Remember that these accounts can be accessed by the public. Charities. Charities exist to benefit the public. Because of this, charities will be exempt from tax for most activities and may be entitled to certain grants and funding. Charities are restricted in what they can do. The rules governing charities are out in the Charities Act. Most charities must register with the Charity Commission. This is the regulator of charities in England and Wales. The Charity Commission and the Office of the Scottish Charity Regulator are responsible for issuing the Statement of Recommended Practice for charities. These recommendations on financial reporting, and will state how the charity will need to report its accounts. The Financial Reporting Council, previously the Accounting Standard Boards, is the body which develops accounting standards. The FRC issues financial reporting standards. FRS 102 is a financial reporting standard applicable in the UK and Republic of Ireland. The SORP follows the FRS 102. Charities must follow charity law and their purpose must be for public benefit. A charity cannot have some charitable purposes and some that are not. A charity cannot have a political purpose. Can't be political. Charities run by trustees who don't normally personally benefit from the charity. They are usually unpaid volunteers, but they can claim reasonable expenses. They must act in the charity's best interest. Must act in the charity's best interest. It's rare but not impossible for trustees to be held personally liable. For any financial loss or legal claim from third party, a charity must set out its purpose and powers in a governing document, often known called a trust deed. What is the expected outcome of the charity's work, where the outcome will happen and how the outcome will be achieved and who will benefit from the outcomes. A charity must be incorporated or unincorporated. An unincorporated charity must register with the Charity Commission. It does have certain benefits over an unincorporated charity. For example, the trustees will have a limited liability. In effect, the debts will be limited to the organisation's assets. The trustees will not be personally financially liable, although they can be held responsible for wrongdoing. An unincorporated charity can employ staff in its own right, rather than as an employee of the trust. incorporation is the extra administration required in setting up the charity and preparing the accounts. An incorporated charity will have to prepare accounts in the same way as limited companies. The financial statements which must be kept are statement of financial activities, statement of financial position, to the which must be generally available to interested parties and some smaller charities may be relieved of supplying an auditor's report or an independent examiner's report. Small unincorporated charities may produce a receipt and payments account listing all money received and all money paid, a statement of assets and liabilities. The trustee's annual report must be generally available to interested parties. These documents combined with the charity's annual return, which must be filed with the Charity Commission. The accounts can be accessed by the general public. Statement of summary. There are many different business structures. A sole trader is responsible for the business alone. A sole trader has unlimited liability for any debts of business. There is no prescribed format for financial accounts for sole traders, but a record of income and expenses must be kept. A partnership is when two or more individuals form a single business. A partnership will have a partnership agreement, or they will be bound by the Partnership Act 1890. Limited companies are separate from their owners. The owners are shareholders. They must submit a statement of profit or loss and a statement of financial position to Companies House annually. A limited liability partnership is halfway between a limited company and a partnership. Charities are managed by trustees who must ensure that the activities are for public benefit. A charity must register with the Charity Commission. Practice questions. Chapter 1. Complete the tables below to show the differences between different business types. Right, the sole trader who owns the business. The sole trader who manages the business. The sole trader who is responsible for debts and to what extent. The sole trader entirely. What is the method of taxation? Please, national insurance and income tax on profits. How are profits distributed? Drawings. All to sole trader. What legislation is in force? The person who owns the business. manages the business? Who is responsible for debts and to what extent? Partners entirely. What is the method of taxation? Drawings. What legislation is enforced? It is the Partnership Act 1890. It's an old piece of limited company. Right, who owns the business? Who manages the business? Directors. Who is responsible for debts and to what extent? The owners. Only as much as they put in. What is the method of taxation? So we've got corporation tax on profits. How are profits distributed? Dividends to shareholders. What legislation is in force? We've got the Companies Act 2006. Limited Liability Partnership Act 2000. Who owns the business and the partners? The members. Who manages the business? The members. Who is responsible for debts and to what extent? The members, to extent they paid in. What is the method of taxation? Members pay income tax and national insurance on own share. How are profits distributed? How are profits distributed? What is the method of taxation? Limited. Who is responsible for debts and to what extent? Trustees. Limited. Who manages the business? The trustees. Trustees. legislation is in force. Pussycat, please stop that. Charities Act 2011. Charities Act 2011. Alrighty, so let's have a look, see at the answers. Practice questions. Right, the individual trader. The individual trader. Yep. The individual trader and the liability for debts is unlimited. Income tax and national insurance drawings, no legislation. Right, partners, debts is unlimited, are also responsible for the business debts of the other partners. Entirely. Right, income tax and insurance drawings. Right, 18. Right, who owns the building? The shareholders. The directors. The owners only as much as they put in. Corporation tax on profits and dividends. Companies Act 2006. Right, the members. They paid in members. Income tax and national. Yep. All that stuff. Drawings. Limited Liability Partnership Act 2000. Trustees. So it's not the public. Trustees. Here's exempt. Use for charitable purpose.